OpenAI and Altman are on a quest to develop AGI, or artificial general intelligence, which OpenAI defines as systems that are broadly smarter than humans and so has the ability to teach itself, thereby creating new, even potentially smarter AGIs. Depending on who you talk to, that could ruin humanity or could supercharge it.
Coming up on today's show, the melt up continues. A look at what's going on underneath the surface. Inflation comes in a little better than expected. Sam Altman's $7 trillion dream. Nvidia now worth the same as the Chinese stock market, which they're vowing to save. Bitcoin on the march higher again. And I'll teach you how stock market algorithms work. And a warm welcome back to the Click Capital Daily Market Show, everybody. Hope you're doing well out there. I'm your host, Jared, and what another interesting week on Wall Street. S&P 500 just putting in its 14th green weekly candle out of the last 15 weeks. And that was thanks once again to the mega cap tech melt up, with the Super 6 as a group finishing up 1.8% today, led by the big fella himself, Nvidia, adding another 3.5%, getting above 720 for the first time ever. Got the biggest stock in the market, Microsoft, breaking out to new all-time highs, now with a market cap of 3.1 trillion. And the momentum train is steaming full ahead with Super Micro Computer, adding on another 6% today, trading above $740 a share. Also got a big rip in Bitcoin today, up over 5%, briefly touching 48,000 a coin, causing some big rips in crypto-related stocks like MicroStrategy, Riot Platforms, and we also got some good moves up in cybersecurity stocks like Cloudflare after reporting earnings. So clearly the market, at least in tech and semis, has gone parabolic in this melt up. It's anybody's guess how far we go before we hit that blow off top, and it's just turned into an absolute pylon. We can see that in the options market today. Even for a Friday, pretty heavy, almost 47 million contracts traded and super lopsided, 61% calls, with a massive 64% of them expiring in the next 5 days. And just look at the difference in the notional values of the calls and puts being traded in these names. And so basically notional value is what the value of the underlying contract is that's been purchased. And Nvidia today absolutely smashed in the S&P 500, with notional call volume coming in a little over 3 billion, far exceeding that of puts of 692 million. Same with Super Micro Computer, which is nowhere near the market cap of all these other big stocks. At only 40 billion, it came in fifth today, the most liquid call options traded, 373 million versus 107 million in puts. Similar ratios in other stocks like Meta, Coinbase, MicroStrategy, AMD, Planeteer, and Marathon. So what does this all say? Well, some of these companies, like I said, they don't even have really big market caps, but people are just piling into the call options on them, which this price action inevitably attracts a lot of. And so like I said, this type of environment's really dangerous to short in, as who knows how high we could go before we pop. Could hit $1,000 a share. It's almost tripled since the start of the year. By the time it gets to 840, it will have tripled. Same with Nvidia. It's looked to have gone vertical here. And basically the higher and harder we go, the bigger the correction we're going to get. And that could spark a bit of volatility in the market, which is still quite subdued looking at the VIX index, under 13 here today. We normally finish lower on the VIX going into the weekend, how the volatility market works. And so even though we've only got 58% of S&P 500 stocks above the 20-day average, in other words, market breadth's still pretty soft here. The whole market is not ripping. Just going back to the weekly chart of the S&P, with those big rips in the semis, it's causing the big indices to start looking like them as well, melting up. And we're starting to see some records and price action, with it closing higher 14 weeks out of the last 15. That's something it hasn't done since 1972. And it's only the 13th time this pattern has happened since the S&P was first formed back in the mid-1950s. And it's only the 6th time it's happened in the Nasdaq since its index was created in 1971. The last time we got this pattern in the Nasdaq was in August 97. And so what's been driving this huge rip in the market? Is it Q4 earnings, which we're getting to the back end of? Well, not really. We've had 75% of companies report earnings above estimates, a little bit softer than the 5-year average of 77. And in aggregate, they're reporting earnings 3.8% above estimates versus the 5-year average of 8.5. So quite a bit softer. And as a group, fourth quarter earnings coming in about 2.9% higher than the year prior. So that's not exactly blockbuster growth. And even though we've got a low VIX looking beneath the surface, we are getting some outsized moves on these earnings results. That's because the average S&P 500 stock has moved 3.6% after reporting, which is about a third higher than the average 2.7% move we got in the past 10 years. And so these large swings could be happening because the outlook for companies far less certain than what it appears to be for the overall market. What the market's really excited about and kicked off in early November is the pivot from Jay Powell from hawkish to a little bit dovish, opening the door for for some rate cuts. Got the market super excited, which was a little bit reinforced today with the annual CPI revisions showing core inflation came down in the second half of 2023 as fast as earlier data showed. So previous reports had shown CPI inflation running at 3.3% annualized, and revised data left that unchanged. December CPI rose 0.2% versus the prior month, down from the 0.3% gain initially reported. But we actually got some bigger increases in October and November. And so over the last 6 months, revised data shows core CPI inflation running at 3.2% rate versus the 3.21% in earlier data. At the end of the day, and for now, it's pretty much a nothing burger. However, it does add to the narrative of evaporating recession fears, convincing the market we're heading for a soft landing if it hasn't already arrived here now. And so even though we got a slight downward revision in the CPI calming investors, the bond market once again went the other way, actually increased a little bit the chances that the Fed will stay on hold in May. Now got 82% chance they're going to hold when they meet again in March, and we're only looking at about a 60% chance they're going to cut in May. And we can see that in the US government bond 2-year yield, which is sensitive to Fed fund rates. Actually looks to have formed a bit of a technical base here, which it could be breaking out of. Looking at 4.48 right now. Same deal with the 10-year at 4.17, holding pretty strong here, which is causing a little weakness in bond prices. And the big one we'll be looking forward to next week is the monthly CPI report due out on Tuesday. We'll get to look probably the most important piece of economic data this month, the change in inflation. With the headline rate expected to come in at 3% year over year, a bit down from previous reading we got 3.4%, and core inflation expected to increase 0.3% month over month. So the stock market's not really expecting any volatility out of that. Would be very upset if it did come in hot. The bond market, however, still near record highs in volatility versus stock market volatility. This is a spread between bond volatility index move and stock volatility index to VIX. See, that's been steadily climbing for the last 2 years. And just zooming out here, still hovering around levels we haven't seen since October 2008. And prior to that was elevated right before the market had its biggest sell-off this century. So what this means is bonds are basically moving around a lot more than stocks, relatively speaking. And that can be a bit of a contrarian indicator, like it was in the COVID stock market bottom in March 2020, when the volatility in bonds just dropped really quickly versus stocks, and we had a good rip up in the market after that. And so it's really AI and the demand for semiconductor chips driving this rally, helping to keep stock market volatility low. You can see this in the daily chart, the semiconductor ETF, breaking out to new all-time highs again today. And no doubt helping that is the guy behind ChatGPT, Sam Altman with OpenAI, who's partnered with Microsoft. Posted on X today, we believe the world needs more AI infrastructure, fab capacity, energy, data centers, etc. that people are currently planning to build. Building massive scale AI infrastructure and a resilient supply chain is crucial to economic competitiveness. OpenAI will try to help. So some people are saying he wants to raise between $5 and $7 trillion, which is a mind-blowing amount of investment. Not sure how he could actually raise that sort of capital and from where and how to put it to use. It just speaks more to the need for chips. And like Jensen Huang from Nvidia said, they don't have a demand problem, they have a supply problem. They can't build enough quick enough. And so this huge boom in AI, coupled with a strong political and business will to reshore domestic production of chips back to America away from Taiwan and the China risk, has definitely got this market moving, with the momentum now looking well entrenched. And that's why we're seeing things like Nvidia is now worth as much as the whole Chinese stock market, second largest economy in the world. That's because now Nvidia's hit 1.7 trillion in market cap, adding over 600 billion just in the last 2 months alone. That's more than Tesla current market cap, so you can think the value of Nvidia has grown by a Tesla in just the last 2 months. And so this big flush out in the Chinese stock market is catching the eye from the man at the top, Xi Jinping, who's not too impressed with what's been happening, actually fired his securities regulator. It doesn't look good going into the Chinese New Year weekend. No doubt it'll be the talk of the table as domestic and foreign investors flee the market. And I'm pretty sure they want to put a bottom in this, stop the national embarrassment, prevent it from deepening, potentially sparking social unrest, with the China Securities Regulatory Commission vowing to prevent abnormal market fluctuations. And so you got to realize the Chinese economy is not in a recession. Still the fastest growing major economy out there, over 5%, just been a huge loss of confidence in the Chinese stock market. The big exodus of foreign capital bailing out because they're worried what's going to happen if they invade Taiwan, which is a legitimate risk. It's something you have to accept if you're going to be long Chinese securities. And there's a look at the daily chart on the largest liquid Chinese ETF on the US stock market, FXI, which I think could be trying to form a bottom here. Got these big volume thrusts up, bullish divergences, and unbelievably looking at a long-term monthly chart, it's at the same levels from the great financial lows in late 2008. And same deal with one of its biggest Alibaba stocks, trading below its IPO price 10 years ago, even though its revenue's grown from 8 billion back then to 125 billion. This just shows the loss of confidence in the market. However, this sets up fertile ground for a contrarian trade, because if the market does change its mind on China, the government and regulators are able to get underneath it and restore confidence, become a bit more business friendly, attract a bit of capital back, then this could be one of the biggest short covering events we've seen in a while, and could create a huge squeeze up as people chase that valuation and bounce off the bottom. But for now, Chinese stock market's been in a bear market for the last 3 years, and it could be showing some signs of bottoming on this peak pessimism. And interesting, just staying on the same monthly chart, Chinese stock market has quite a bit of correlation with the clean energy sector, which it too has been in a bear market for 3 years now. Doesn't quite have the same strong technical sign of a bottom being put in like China. However, the valuations are starting to look good throughout this sector. But for now, a lot of people have been burned, and so it's understandable a lot of investors have turned their backs and given up on the China trade. Okay, so on today's show, I wanted to talk a little bit about algos. And I think a lot of people misunderstand them, and you hear about it a lot. Oh, it's the algos controlling the market. The algos doing this, the algos doing that. And it's true, they are very dominant in the market in modern days, responsible for over 80% of volume, and actually manage more assets under management directly than humans do, and permanently held by people and companies as well, and dominate the percentage of institutional trading volume, with quantitative funds coming at 35% and hedge funds, big users of algos, coming in at 30% as well, well above asset managers and banks. Okay, so what is an algorithm? Basically just a piece of computer code, a program that buys and sells stocks or any other asset according to some predetermined rules. And so who uses algos? Well, pretty much everyone. Big banks, index funds, hedge funds, quant funds. Even I use algos in my trading. And so let's take a look at the most common types of algos out there. First being accumulation distribution. This is kind of like the bread and butter of algos, and what I use myself to build a position or get out of a position. And basically, instead of just hitting a market order, crossing the spread, paying the spread, typically accumulation distribution algos are broken up into smaller chunks and run over the course of a day or several days, attempt to achieve a volume weighted or time weighted average price. And this is the most basic type of algo. So, if you've got an order to buy 10,000 shares, instead of just hitting the market, lifting the offer for 10,000 and likely getting a bit of slippage, algo might randomly break it up and sit on the bid or try and get filled at the midpoint, something like that, just to improve a fill. And importantly, try and not tip off the HFTs, high frequency trading algos, which attempt to front run these large orders that big institutional funds have to do, and index funds and Vanguard, State Street, BlackRock. They got money coming in every day. They've got to buy up all the index components, and they'll just use accumulation distribution algos to do that. Next type of algo is arbitrage mispricings. So it's done by quant funds. Simple example of that is the S&P 500 futures against a basket of stocks which has a high correlation with S&P. That's a very efficient part of the market that's been arbed away for many years now. Pretty much only available to the biggest and fastest, most well-resourced quant funds, with servers co-located next to the exchange. Similar is statistical arbitrage, StatArb, which seeks to exploit short-term inefficiencies of relationships and patterns in the market. So a simple example of that could be the price of Coca-Cola versus Pepsi shares, or the relationship of bond yields and utility stocks. And so big firms like Renaissance Technologies mostly focus on StatArb, things like that. Then there's market making. Big firms like Sidel take the other side of trade on free trading apps like Robinhood, look to capture the spread and kind of just balance their book out by being delta neutral so they don't take on much directional risk. And there's high frequency traders. Like I said, they trade on momentum and a little bit predatory. They'll try and sniff out big orders in the market. And what they'll do is they'll lift the offer, get in front of the accumulation algo, and then post a higher offer to sell to them. Then you've got breaking news algos. They're connected to the news wires, got machine reading to decipher what a news release means in a millisecond, go straight into the market, buy and sell, getting ahead of the crowd. And then the last one, and you won't hear much about this, and I'm just speculating a bit here because you really can't find much literature about this, but I'm pretty sure it's out there, is what I call rug pull algos. Some of these big funds, I'm pretty sure they've got things where they kind of looking at positioning in the market and particular markets, and they're looking for spots where the crowd is lopsided in one direction. Then they'll push the market in the other direction, looking for an unwinding in their favor. And so one recent example where I think that happened was in the stock Snap, social media company that just recently reported earnings and got absolutely smashed down on it, even though they came in with a bit of a better beat than was expected from the street. And so there's no real correlation of the beat and guidance and the stock price's reaction afterwards. It's kind of a little bit random, but is it entirely? Because back here on the 6th of February, the market traded up over 4%, and a large social media influencer, Dave Portnoy of Barstool Sports, who has 3 million followers on X, posted on Twitter before earnings that he was long calls. In other words, he was expecting the price to go up a lot, and you just look at the amount of views his posts on X get. hundreds of thousands, if not over 1 million. And so these sophisticated algos from these big funds that sit there all day just trying to beat the market, they look at social media, they look at sentiment, they look at where the crowd's at. They can decipher all this information and data, like I said, to try and work out positioning in the market. And you can just see by looking at the chart, Snap had a huge run up over the last couple of months, was trading above its 50-day VWAP going into earnings, and traded up over 4% that day on huge volume. So Dave Portnoy probably pulled in a lot of people with him, a lot of retail traders following him, and he's pretty much advertising to the market and algos his hand. And so just imagine if you've got unlimited funds and then you know a bunch of people along Snap, where's the opportunity? It's to force them out of their long positions in your favor. And so just going down to a 5-minute chart on Snap the day before earnings, there it's trading up. It releases earnings and initially fires right up, coming in with the beat, probably sucking in even more people. But then look at the next 5-minute candle. Whoops. Rug pull, down 30% on huge volume. So algos come in here, started selling it at high 18s, probably sold it all the way down to 15, 14. And then everyone else who's just seen their quotes update on their screen, refreshing, it's like, oh no, look what happened. What did Dave do to me? Bail, bail, bail. That 5-minute flush candle closes at $12.88. And look where we opened the next day, around $12 a share, and kept falling as well. So it's likely the algos that did the rug pull back up here at 18, 17, 16, 15, were sitting on the bid all overnight and then into the open as well, just getting out of their position. Now that's just my speculation of what I think happens every day in the stock market, as some of these big funds will try and use every data point they can get their hands on, feed it into the algo to work out investor positioning in a market. And when it's lopsided, where there's an opportunity and something like an event like earnings, like I said, doesn't really matter what the number comes in. They can just cause a big reaction. I know a lot of people like to punt on earnings. Just put in some huge sell orders. Hit the bid, flush people out, then just sit back and let them unwind after you. And then you can literally buy back their shares at a lower price that they're selling to you. And so that's what I call rug pull algos. And you've got to be careful if you find yourself on the same side of the crowd. And you can't just follow someone like Dave Portnoy and expect to make money. Like I said, he probably doesn't even realize he's advertising his hand and the hand of others to these algos to feed off. And so if you'd like to learn more about how markets really work, well then I'm releasing my first ever online course this coming Monday night on the show you're watching now. And you'll be interested in Module 2, How Markets Work, where I talk about things like this and how to best work your orders into the market, how you can also use algos to get filled, reduce your slippage, not tip off your hand to the HFTs, and just improve your overall execution. I think that's a topic a lot of people are kind of ignorant to and not even really aware, and the long-term costs of paying the spread and slippage, and how you can actually improve your fills and get the exchanges to pay you by becoming a liquidity provider and getting a rebate. I also show you how you can do some of these strategies like stat arb in a basic form called spread trading or pairs trading. I'll give you a list of a couple of hundred spreads that I've already tested for co-integration. I have a real relationship of mean reversion, and I'll show you exactly how you can find some of these trades and assets that have a stable and statistical proven relationship. I'll also share with you exactly how my option selling income strategy works, how you can generate weekly and monthly income by safely selling options and taking out the tail risk. Once again, showing you how to work orders through the market. And that's just a couple of many topics I cover in my course. There's actually 25 modules, over 12 hours in content with no fluff or filler. Stuff I've never talked about on the channel. I've kept all my best stuff for my course, something I've been working on for over the last 6 months. And so if you like this show, then you're going to love my course, and I'm sure you're going to learn heaps from it. So make sure you come back to the Click Capital YouTube channel next week, and I'll show you how you can get immediate access to my online course, which you can watch on demand and learn at your own pace. You can even stream it to your TV. And I'm going to be offering all you guys a really good discount for the first week only. And I know you're going to love it and find a lot of value in it. So I'm really excited to launch this next week. Just moving on with the show, we've got oil on the rise. Still got a bunch of conflicts happening in the Middle East. We're yet to see how Iran's really going to respond to the US and West's strike back on over 100 targets in the last week, and whether Iran's really going to dial it up here and try and throw a spanner in the works for the Biden administration going into the election. And that's why they want Israel to cool things down. However, Israel don't want to cool things down. They're launching new airstrikes into the Gaza Strip, rejecting a ceasefire deal, and with the US economy still holding up really well, demand's there, and so we saw oil move up a bit this week, now holding ground above its 50-day. But another proxy for the conflict in the Middle East, price of gold, where investors will seek safety, it isn't really moving up. Did start to move up a little bit last week, but like a lot of markets, we're just consolidating sideways here. What is no longer consolidating and ripping up is the proxy for market liquidity and sentiment, Bitcoin. Some of this momentum in tech stocks, chips and semis spilling over to cryptos, and you can see that in the price of Bitcoin moving strongly up in the last couple of days, getting above 48,000. Just taking you out to a weekly chart there. We had been consolidating since early December, bit of a bull flag, appearing to be breaking out now and testing those highs we got on the launch of the new ETFs in early January. And this is kind of a bit of a test for Bitcoin in the long term. Looking at a monthly chart here, I've had this Fibonacci and resistance zone drawn in for a little while. We're currently right in that kind of golden pocket of 50 to 62% retracement on the move down from those 21 highs. So if Bitcoin can break out here, get above 50,000, the higher we go, the more likely it's not a retracement and could be a sustained bull market. However, if it were to stall out at 50,000 and retrace, then maybe this is still a retracement level from this move down. And just looking at Ethereum, it's got a bit more work to do as well. It's even getting close to approaching its all-time highs just below 5,000. And a good sign for the regional sector is we've got insiders from New York Community Bancorp, which have been slammed recently, actually buying up their own stock, with the chairman buying a bit over 200 grand worth of stock. We can see that causing a bit of a bounce today in the price, up almost 17%, trying to put it in the bottom here after this big volume hammer. And this is a real pocket of risk for the market. Currently, that the rest of the market's really not paying attention to. So if it can hold here and bounce, that'll be good for the overall regional banking sector and financials as a whole as well, which is still consolidating just below highs. No surprise, the fear and greed index still really elevated in the extreme greed zone. But once again, corporate insiders still doing way more selling than buying. Still seeing record transaction ratio. There's a look at the dollar index, which has strengthened a lot over the last month. Typically a negative for the stock market. And this is a bit of a divergence. Stock market just doesn't care. It's kind of decoupling from these other markets a bit. So we've seen the rise in yields in that time as well, and even things like shipping rates, which could cause an uptick in inflation numbers in the months ahead. Not to mention we're getting a bit of a move back in the price of agricultural commodities, which will feed into our food prices in the months coming as well. Looking across the world, don't really have a huge amount of bullish momentum in international stock indices. There's Canada's TSX, the UK FTSE, the German DAX consolidating as well. China 50 trying to hold a bottom. One of the best performing markets, the Nikkei out of Japan, and the Aussie 200 kind of just consolidating below highs as well. There's a breakout in the growth versus value stock spread and a pretty big move up in discretionary versus consumer staples, and a sign of a risk-on move. The spread for global growth, copper versus gold, still weak and still in this medium-term downtrend, but the market doesn't care. It's a clear risk-on sentiment. We can see that with high-yield bonds breaking out versus treasuries. And with the weaker sector today actually coming in with energy down 1.5%, gold miners as well, starting to fall away from the price of gold. Good move up in one of my picks this year, cybersecurity stocks, Hack. Now within a point of all-time highs, pretty flat there today for Apple. Alphabet popped up, along with Amazon breaking out again. A little bit of a pullback in Meta and Tesla, trying to hold ground above 190 here. And that move up in New York Community Bancorp, helping some of these other regionals hold their ground, and the big guy JP Morgan still consolidating up there. All right, guys, there we are for the week. S&P 500 finishing over 5,000. Parabolic momentum looks to be showing no signs of stopping. It'll be interesting to see how much further we can go next week, whether we get any surprises out of CPI on Tuesday, and just how much further Nvidia and Super Micro Computer can go. Other than that, we've got the Super Bowl in America this Sunday night, with the Kansas City Chiefs playing the San Francisco 49ers, and the 49ers coming in a close favorite, just looking at the odds out there. So I'll be watching that one, as I'm sure a lot of you will be too. Other than that, come back to the Click Capital channel on Monday night when I'm opening doors to my online course and offering you guys a big discount for the first week only. So I'm really excited about that. Thanks very much for tuning in to the Click Capital Daily Market Show today. If you found some value in this video, please hit that like button. Have a great weekend, and I'll see you next week. Cheers.